makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone. Happy Monday. Welcome to The Pulse. I'm Francine Lacqua here in London. Now, China is accusing the U.S. of violating their recent trade deal, promising to take measures to defend its interests. That's dimming the immediate prospect of a leadership call that President Trump is seeking. But U.S. Treasury Secretary Scott Bessent remains optimistic.
That when President Trump and Party Chairman Xi have a call, that this will be ironed out. So, but the fact that they are withholding some of the products that they agreed to release during our agreement, maybe it's a glitch in the Chinese system, maybe it's intentional. We'll see after the president speaks with party chairman.
Well, we're now joined by Rosalind Matheson, our EMEA news director. Ros, I guess it was always going to be quite a lot of trade tensions that flare up and then go back down. Are you surprised by what we've heard, both sides, China and the U.S., accusing each other of breaking the deal?
Well, it just shows how complex this relationship is, and it's not just necessarily about trade itself, because also in all of this, China is accusing the US of revoking the visas of students who want to go there and study. We had the Defence Secretary in Asia on the weekend at a speech in Singapore saying that China is eyeing, action against Taiwan. And so you put all those things together, trade, defence, other parts of the relationship, and keeping trade on an even keel becomes even more complicated. And so these ebbs and flows, as you say, are unsurprising. We've seen this pattern over and over again. There's a bit of a trade understanding between the US and China, often brokered by direct conversation between Xi Jinping and Donald Trump, or Xi Jinping and Joe Biden, perhaps even a dinner, and they resolve it. It's all okay for a little bit, and then it goes off the rails again. And so this is not uncommon in a relationship this complex and fast-moving. The question is, what's it going to take to get this back on an even keel?
Yeah, and of course, I mean, because the two economies are so big, it involves everyone in the world. And then the EU, just a short time ago, we had this headline saying, the EU will probably curb China's access to medical devices procurement. So does the EU now need to choose sides?
Well, it's difficult for the EU as well, because this was an investigation that started back in April, I think, and now they've made a decision. It's obviously quite a targeted action.
Yeah.
It's about these concerns, again, around supply chains and procurement when it comes to Chinese companies, and it's about the medical sector. I mean, that's not insignificant, but obviously at the same time, the EU's trying to balance the relationship with China. We can see, the narrative from EU officials about needing to keep the door open to China, especially, again, you've got the trade tensions, conversely, with the US. So the EU is trying to have a relationship with China, and like everybody, trying to put things in compartments, a bit like the US. So you put this medical procurement scoop, which we just broke the news of a short time ago, in one compartment, but you keep the relationship more broadly going. And that's the difficulty, is how to nuance all of that.
Ros, thank you so much, as ever. Ros Matheson, they're very good, of course, at unpicking everything with clever nuances. Now, the International Airport Transport Association's annual general meeting and World Air Transport Summit begins today in New Delhi. The gathering in the Indian capital comes as the aviation industry grapples with the threat of Donald Trump's tariffs, potential supply chain problems, and a slowdown in transatlantic travel. Let's head to New Delhi, where Guy Johnson is standing by with a guest. Hi, Guy. Good morning.
Good morning, Francine. Thank you very much indeed. Yes, we are joined now by Shai Weiss, who is, of course, the CEO of Virgin Atlantic. Nice to see you.
Nice to see you, Guy.
You told us a few weeks ago that there was some softening in the North Atlantic.
Yeah,
what's going on now?
Yeah, I think that it's a common question. I think since tariffs were announced on the 2nd of April and until the stay of execution on April the 9th, we have seen some softening. But it's rebounding a bit. It's hard to determine what the slope of the rebound is.
Yep.
Premium
what does it look like right now?
Yeah, so improving versus the April period. Premium strong, leisure a bit weaker, and really concentrated in the United States. I think a bit of uncertainty.
So when you say concentrated, what do you mean? You mean US travelers coming into Europe?
That's right. Yes.
Okay.
I think
is that a dollar-related story, or is
no,
that?
I don't think it is. I think it's literally an uncertainty-related story. And travelers like certainty. Whether you're a business or a leisure, whether you're going to meet family or friends, you just want to know that things are just going to be as you expected them to be in terms of your savings. What are you spending your money on? It has improved. A bit of, I think you've heard the theme across, a bit of weakness, a bit of softening, I would say, in the yield side of things. So volumes are there. It's a bit of price, but it's improving day by day right now.
How much room have you got on price? Is fuel helping? How quickly can fuel help?
Fuel is very stable at $65. The pound is a bit stronger versus the dollar. So all these things in the balance help airlines. But fundamentally, we need strong demand to continue, which we're seeing that emerge after a very strong start to the year.
Was there any effect off the UK-US trade deal? Did it in any way meaningfully change that degree of uncertainty?
I'm going to be kind on the US-UK trade deal. I think actually we're in India. More significant is the India-UK trade deal.
Okay.
We're now at the fourth largest economy here in India. For us, it's 25 years of flying here, 1 million seats. We've really grown 350% over the last 5 or 6 years. I think this is more meaningful as India moves from just a service economy to a manufacturing economy. This is really significant for the UK.
The airline then?
Virgin India.
You got Virgin Atlantic. That was the priority. Are you saying
Maybe
that
a
now?
Subsidiary, but you've known we've just announced actually yesterday a partnership with Indigo together with our partners Air France and KLM. This is really about taking account of the strength of our joint venture and expanding it.
How big could this market be?
There are about 4.5 million passengers a year to the UK, about 7 million passengers to the US. Less than 10% of the population here have a passport. I think this can be very, very big.
Okay, so this could be a very big market. I want to take you back just to the US for just a moment. Do you get a sense that the uncertainty is, we just don't know what is going on, but do you think, I'm trying to isolate which factors are the most important at the moment. Is traveling, but is traveling to the US just more difficult now, more nerve-wracking, more...
Especially out of Europe, we've heard that there is some negative feelings towards the United States. Of all the countries in Europe, and I count the UK in Europe, we are the least impacted. People love traveling to the US, whether it's for business, of course, New York, San Francisco, Los Angeles, but also to Florida. So I think the operative word here is sentiment. Travel in all its types is impacted dramatically by sentiment and certainty. Inward investment, what are the rules of the game? And I think we're just waiting to see what happens in July after the 90-day pause on tariffs is. But I already see that people, even in this period, they adjust very quickly, and we're seeing a rebound in volumes and in price affect all types of travel.
In terms of the other story that I'm hearing around the halls here is that costs are going up. That tariffs do actually mean higher prices for spare parts, for engines, for you name it. It's going to. How inflationary do you think it could be?
Look, this is a question really for the economists, but there have been...
Aviation CEOs are basically economists. You have to be economists. You have to be
economists. You're not going to let me off the hook on this one. Okay, so I'll take the question and answer it. I think it's fair to say that prices have gone up, of course, over the period through the pandemic. We're entering into a period of more stability in the supply chain. Engines are late, planes are a bit late, and we're seeing a recovery, but the tariffs no doubt will make it, will have an impact on the price of goods, the price of transport, changes of production. But these things take time. They don't adjust overnight. So now I think we're just going to have to see how it settles, and then people adapt relatively quickly.
But it sounds like you're also telling me that you're going to deprioritize the US. Is that fair?
No, and for us, it's not even a possibility. Neither do we want to do that. It's Virgin Atlantic. We always say it wouldn't be Virgin without the Atlantic. 60 to 70% of our capacity is to the United States. It's our more profitable and our more successful. And no, I don't think we need to deprioritize. But having said that, you can see the growth into India. We've announced, of course, we started a flight to Saudi Arabia. We're going to start a flight into Seoul next year in March. Cancun is coming. We launched Toronto. So a balanced approach is the right approach.
Okay. But there is an emphasis. Ed Bastian, I had the same conversation with him. Your good friend. He was talking about, he sees he's got 100 years. You've got 25 years. He sees the next 100 years as being outside the United States as being the growth opportunity. Is the growth opportunity outside of the United States now?
Look, first of all, 40 years of Virgin Atlantic, 25 years of flying into India, and yes, there is growth. There is growth in India, and that's why we bet on it. Actually, in 2019, we looked at our portfolio and figured that we could really only support one amazing growth market and made a bet on India to the detriment of other locations, including China. It happens to be that the bet seems to be working out. We now have 5 daily flights into Mumbai, Bengaluru, and Delhi. With our partnership with Indigo, we connect into 36 domestic destinations. So the sky is the limit, and when Indigo is now flying into Manchester, into Schiphol, we can connect these passengers. 40% of the passengers flying out of India connect onwards, either in the UK or the United States. So I think it's really about the connectivity, it's about the partnership with other airlines, and of course it's a betting on fast-growing markets, which is India.
Not China, though. It's interesting that the world seems to be shifting. This is now, maybe just because we're all here, but this is being perceived as being the big growth market. India is the growth market. China is not the growth market. Am I looking at it the right way?
I wouldn't write China off. You know, it's still the second largest economy, and there's a long way for India to catch up to China.
Sure.
But I think in terms of momentum, the momentum is very much here. It's palpable. You can feel it. You can see it. And you can hear the conversations. If it was an outsourcing conversation in the past in the technology sector, it's now potentially a manufacturing, aided by, of course, trade deals, aided by tariffs, which rebalance the world economy.
Shai, great to catch up. Nice to see you.
Thank you.
Sorry to get my dates wrong, but you corrected me, as it. Shai Weiss, the CEO of Virgin Atlantic. Thank you very much indeed. Francine from New Delhi, thank you very much. I will hand things back to you in London.
It was a great interview, Guy Johnson, with the chief executive of Virgin Atlantic. I learned especially on this India-China divide. Now, coming up, we'll check in on markets with Tunde Lawal from Barings as the U.S. and China accuse one another of violating their trade war truce. More on that next, and this is Bloomberg. Well, growing trade and geopolitical tensions are again prompting investors to hold back from taking risky bets. Let's bring in Bloomberg's Valerie Teitel with the latest. Val, what do you have?
Hey, it's a risk-off move across markets. Global equity markets are in the red. You got the U.S. market, the European market, and even the Asian markets in the red this morning. We also have the gold also on the front foot. Take a look at what's been going on, up near 2%. This is a big standout mover on this risk-off move today. That's gold up 2%. The one asset, though, that is not responding like it normally should in a risk-off move is the U.S. dollar. This is the Bloomberg Dollar Spot Index. We're on a back foot, down 0.5% for the broad dollar index. And that's after the Bloomberg Dollar Spot Index has now fallen for 5 straight months. So momentum really is on the back foot for the U.S. dollar. I want to end on one more thing, and that is the long end. What's going on in the long end yields? Treasury yields, German yields, and gilt yields all rising quite steeply in the long end. Those 30-year gilt yields up some 6 basis points. So some weakness across fixed income as well. Francine.
Valerie, thank you so much. Valerie Teitel there with the very latest market moves. Now, we're also joined by Tunde Lawal, head of EMEA Corporate Credit and EM Corporate Debt at Barings, and Brendan Murray, our global trade czar. So Brendan and I were joking that it's always up and down. Like something seems to go well, and then, whoop, they're not, as happy as they could be. Tunde, just talk to me a little bit about how the market is reacting, because the market seems to be more on an optimistic mood in general, and then in trade like days where there's tension, they sell off, but they don't sell off hugely. So what are they actually pricing in?
Well, I think markets are telling us no one really has a crystal ball and everything seems a bit uncertain, right? Because I think that's the thing, that this trade wars are really bringing so much uncertainty to everything. Some days, historically, when we see treasuries sell off, it's because maybe there's, treasury yields go higher, it's because maybe there's strength of the U.S. economy, and so treasury prices go down. But recently, the sort of rising treasury yields has been more a sign of concern around U.S. fiscal policy. And so that's making people a little bit concerned where treasury yields are going up, dollars going weaker. It's sort of that correlation's breaking down. I think it's the weakest correlation in about 2 to 3 years as well. So markets are telling you that they're a little bit confused. And so people are sticking to buckets of what they feel comfortable with. And so if you're looking at credit, then you're sticking to, say, high quality end of credit. And if you're looking at sort of private credit as well, you're sticking to sort of well-known issuers in that space. So I think that's what the market's a little bit confused.
Yeah, I like that. I mean, honest markets, actually, because a lot of us are pretty confused. Brendan, when you look at trade, it was never going to be plain sailing ahead because of this tension between the U.S. and China. Is it better than you expected or worse than you expected?
It seems seems to be about the same as we expected. This was 3 weeks ago. The two sides, the U.S. and China, got together in Geneva. They said we'll have 3 months to work this out. Here we are 3 weeks on, and they're still not even really talking. In fact, they're pointing fingers at each other, saying you're not abiding by the agreements that we agreed to. So I think it's a real test right now. President Trump seems to think that the tension and the escalating things drives the Chinese President Xi to the negotiating table. That seems to be a fundamental misunderstanding of what would bring the Chinese to the table, which is mutual respect, calm, and some sense that they can accomplish something meaningful and positive. And right now, the tone for that is just non-existent.
So what would bring the Chinese back to the negotiating table?
It would seem, well, I can tell you what won't bring them to the negotiating table, and that is these geopolitical things that they're doing with student visas in the U.S., with export controls on Chinese technology, the kinds of things that, escalate tensions rather than bring them down.
Tunde, I mean, as you say in your notes, there's obviously winners. I say obviously, actually, it's not clear who the winners and losers are because we don't exactly know where these tariffs or trade end up. But again, how do you identify the potential winners? Is it more countries, emerging markets? And is that a good way how do you know the entry point?
Well, hard to know entry points, which is why I say you pick things that fundamentally you find you like and you think that they're strong. And so when we think about the way we've sort of done preliminary analysis in terms of winners and losers is we're thinking of if there's tension between US and China, what does China buy from the US and what does the US buy from China? And in that sort of scenario, you look at the guys who are exporters of commodities like the soybeans, the corn, things like that. Brazil, Argentina. They export beef, they export soybeans, all that. They stand to benefit from that. You look at places like India, where it might be a place where you could transfer some of the production of iPhones and tech and some of the things from China into India. So there are some places that could be winners and losers there. And so that's the kind of analysis that we've done, where we've picked companies in certain sectors that would benefit from that. And then regionally as well, I think the GCC is largely immune from the trade wars, right? Apart from the exposure to commodities, the GCC is largely isolated from this. So again, there are pockets of the GCC that you can look at because they actually have their own idiosyncratic events going on where they're transitioning from being predominantly hydrocarbon economies into more diversified economies. So there's a lot to do in Saudi, there's a lot to do in Qatar, there's a lot to do in the UAE as well.
How do you look at inflation? There does seem to be a narrative from Fed officials in saying, look, they have this dual mandate, but actually they worry that inflation picks up in the third and fourth quarter. What does it mean for inflation in other parts of the world? And again, how you play it?
Yeah, so that's actually quite interesting. And I think the general expectation is inflation will tick up in the second half in the U.S., as you say, from this trade tensions. I think we haven't seen that data come through yet for April, but I think subsequent data should point us to that. But in the rest of the world, I think China has been exporting some of that deflation. I think Europe has been a big beneficiary of that and should continue to be a beneficiary of that if you get trade tension between China and the U.S. and more of the goods find their way into Europe. That benefits Europe, actually. I think today or this week we're expecting the ECB maybe does 25 basis points, but we're expecting that the preliminary numbers will show that inflation in Europe is actually closer to the 2% target. And so that actually gives a bit more of a tailwind to Europe in terms of ECB being able to pause. And then generically within the rest of EM, we're actually seeing a lot of the EM central banks actually on hold or actually cutting. So inflation has been relatively more muted in other parts of the world outside of the US where we expect it to go up. So that's the kind of way we're thinking about inflation.
And I'll ask you about Europe in a second. But speaking of Europe, we had this headline earlier today saying, look, the EU is poised to curb China's access to medical device procurements. But this is not because of the immediate trade war, right? They've been looking at this for quite some time. So it's retaliation for, how does it fit into the general trade wars?
Well, it fits the textbook definition of reciprocity. The European Union would say, look, China doesn't allow us a fair shake on local procurement. So we're gonna do the same thing with China. So it's another take on the reciprocal. President Trump uses the word reciprocal tariffs, and he imposes them, unilaterally. The European Union, as you said, has taken almost a year to investigate this, and now they're coming out with, or they're voting on, it sounds like, and our folks in Brussels have the scoop on that today, that they're poised to implement that reciprocity.
A lot of chief executives from Europe and other places, I always ask them, do you have to choose between the U.S. and China? And they all say, absolutely not, we can do both. Can they really?
Yeah, it points out this interesting dynamic where the focus is on the trade war is always on Washington and targeting China or targeting the EU or targeting other countries, where the EU is really caught in the middle and is trying to balance that and follow the de-risking strategy, the sort of strategic autonomy, as opposed to decoupling, which is what you would hear from the China hawks in Washington.
Tunda, where do you put Europe in kind of your general appetite for markets?
I think Europe and emerging markets actually stand to benefit from the uncertainty that the U.S. is fostering at the moment. And I think I saw a stat from your Qatar from last week where someone said of every dollar that had been put or invested over the last 5 years, 80 cents of every dollar went to the U.S. And so it was only 20 being assigned to the rest of the world. And I think now there is a case for diversifying some of that 80 cents, right? And it's not a case of taking cash out of the U.S. necessarily. It's just being more aware and addressing that disproportionate allocation, and I think that makes sense. And I think that's where Europe comes in, because Europe, at the start of the year, I think we were quite dour on growth prospects in Europe, but that's since turned around somewhat since we had German and wider EU defence spending plans coming through. So there's some sort of tailwinds coming through. If as you say, Europe doesn't pick between US and China, Europe tries to sort of stay the course between both, however difficult that is, then potentially, you have certain pockets of Europe that benefit from that. Same thing for emerging markets as well. I think there's so many different good things for emerging markets. Corporate fundamentals are very strong in emerging markets. You've got sort of much lower starting debt levels. Central banks are cutting rates, which gives you a good tailwind. And there are really very good sectors within EM, as well as Europe as well, that benefit from a weaker dollar as well. So you focus on your domestic sectors. You go your domestic tailwinds from lower rates domestically. You do banks, you do utilities, you do infrastructure. There's so many things to pick from that actually it's a good time to be doing Europe and EM.
Yeah, and this is, corporate credit.
Correct.
It's corporate credit. So, in banks, there's so many questions about consolidation, things like that. Do you put that to one side, or do you also have to follow the kind of individual, companies and what they're doing in terms of possible M&A?
For the banks, generically, the themes are, so long as you're seeing credit growth coming through, right? So at the start of the year, or so far year to date, we've seen much stronger growth in peripheral Europe versus northern or core Europe, right? So the banks in peripheral Europe have actually outperformed core Europe. And so you're picking up on credit trend growths, what's going on there. And we've seen that consolidation happening. That's helping. The sweet spot within the European banking sector would be probably the tier 2 space. And then within emerging markets, you've got lots of different countries where you're actually having very strong credit growth. The GCC as a region, for example, very strong credit growth across the UAE, Qatar, Saudi even. We've seen a lot of Saudi bank issuance coming through. Same thing, Mexico as well. Credit growth slowed down a bit, but it's still very good as well. And, we've seen some supply coming out of Chile, Peru, places like that. So there's a lot to pick from. That's the beauty as well of, say, sort of something like emerging markets, is the underlying diversity that the asset class brings. So you've got 80-plus countries to play with.
Tunda, thank you so much. Tunda Lawal there from Barings, and Brendan Murray, our global trade czar. Two very actually busy analysts and team leaders. Now coming up, a pro-Trump nationalist wins Poland's presidential election in a potential dent to Prime Minister Tusk's ambitions. More on that next. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Well, tariff tensions test investors. China and the U.S. accuse each other of violating last month's trade deal. A nationalist candidate backed by Donald Trump wins Poland's presidential election in a blow to the country's pro-EU government. Plus, Ukraine stages a dramatic series of drone strikes deep inside Russia, while Moscow launches one of its longest missile and drone attacks. This ahead of planned peace talks today. Now, more on that story now. The conflict between Ukraine and Russia has ratcheted up, but just as the two sides are set for a second round of peace talks in Istanbul. For more, let's bring in Greg Sullivan, our Russia economy and government editor. Greg, thank you for joining us. An escalation on both sides. What do we know?
Well, that's right. Over the weekend, Moscow launched one of its longest and largest drone and missile barrages against Ukraine. They've been hitting Ukraine pretty hard in recent weeks, but it was actually a Ukrainian attack on Russia that was quite interesting. It was potentially the most audacious attack into Russia, and President Zelensky said that it had been in the planning for over a year and a half. Basically, Ukraine took about 117 drones, which they had snuck into the country, sometimes hidden in trucks, launched against these strategic bombers, which will be very hard for Russia to replace. There are differing accounts of the damage. A Ukrainian official said about 40 of these strategic bombers were damaged, whereas the Defense Ministry in Moscow said that they only acknowledged several aircraft. Military bloggers that tend to be pro-Russian said that it could have been 13 bombers, but nonetheless, these are very hard to replace because they have foreign components, and sanctions prevent Moscow from getting their hands on that technology. So it was a very audacious move and likely to be very painful for Russia moving forward.
Greg, do you expect anything to come out of the peace talks?
Well, that's the peace talks that are starting today in Istanbul. Of course, they follow the peace talks that happened earlier in May. Those did not produce much. What we saw was an agreement to exchange prisoners, but Ukraine has been demanding a ceasefire that Russia has so far refused. Russia has largely stuck to their maximalist demands, and so those talks made very little headway. It's probably going to be a similar situation coming out of these talks. Not much progress is expected. Ukraine has been calling on Russia to agree to that ceasefire, but Russia keeps saying that they want a bigger solution to the end of the conflict that includes many of their demands that will be very hard for Kyiv to swallow. So while it is progress that the two sides are meeting despite these attacks, it's probably not going to produce any large headline agreements.
Greg, thank you so much. Greg Sullivan there with the very latest on Russia, Ukraine. Now, pro-Trump nationalist candidate Karol Nawrocki has won Poland's presidential election in a campaign that's laid bare the political polarization within the country. Let's go straight to Warsaw, where Bloomberg's Oliver Crook joins us from the presidential palace. Ollie, good morning. So what's the mood on the ground? And what impact could Nawrocki's victory have on Donald Tusk's government?
Yeah, Francine, it's been really quite a roller coaster in terms of political development over the last 24 hours. When we got in yesterday, we got the first exit poll at about 9 p.m. last night, and it was showing that the centrist candidate was actually ahead there, not by a whole lot, admittedly, but then by the morning and this morning still, we found that actually that result was inaccurate. It was totally reversed. In fact, it was the right-wing candidate from the Law and Justice Party that is being supported that actually won the presidential election. As far as sort of domestic Polish politics are concerned, this basically will create a situation that you've had for the last 2 years under Donald Tusk's premiership, where you have basically a stalemate between the presidency and the prime minister. The prime minister is sort of the main office within Poland, but the president has a lot of power to veto legislation and be really involved on a number of different issues. He's a representative, for example, of Poland to NATO. So these are the kinds of ways in which you are expected now to have a prolonged era of sort of political paralysis here within Poland, particularly at a time when Donald Tusk came in to really set out a very sort of ambitious liberal agenda that he's basically been unable to do for the last 2 years, in large part because of the sort of the holds and the sort of presidency not being in his control, and that is set to continue here in Poland.
What are the implications beyond Poland for the EU and European politics?
Yeah, so, with a lot of these elections across Europe, you've had a lot of engagement in many instances with the Trump administration coming in and backing a certain candidate. You saw it with Elon Musk and J.D. Vance in Germany. You saw the same thing in Romania, and Poland was no exception to that, where you had Kristi Noem, the security advisor, the Homeland Security Secretary for the United States, who just showed up in Poland a couple of days after the first round of election and endorsed the right-wing candidate who has now won the presidential election, saying that basically the other candidate was a total train wreck, and that if Poland wanted to retain very good political ties with the United States and wanted to continue to rely on the United States security support, that they would have to basically elect this right-wing candidate. I'm not sure how much of a decisive factor that is going into this, but it shows sort of very clearly what the Trump administration is favoring, both on the question of sort of European conservative values, but also the fact that it creates more undermining of the sort of unity within Europe, where you have a candidate here and now a president within Poland that is much more Eurosceptical at a time when Brussels and the Europeans would really like to see much more solidarity, particularly as they face off in a trade war with the United States. That caught a blow here in Poland.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on this election and the implications so far. Now, the ECB is set to lower interest rates again this week, with euro area inflation expected to fall closer to the ECB's 2% target. Well, with us now, Jens Eisenschmidt, Morgan Stanley's chief Europe economist. Jens, thank you for joining us. I mean, there's a lot going on. I don't know whether there's a last cut coming actually this week before September, or what kind of levers the ECB is looking at.
Yeah, no, I mean, first of all, our expectation is that's not the last cut, but they will sort of slow down the speed by which the cuts take place. So we have actually the next cut in September, and then a last one by December at 150. Now, what they are watching, or what they are seeing? I think they will stress a lot the high uncertainty, which has not gone away really. I would also expect that there are further downside risks to growth flagged, even though the growth expectations, in particular for 2026, will be marked down. And of course, there will be a debate what to make of the inflation developments. It's clear, and I think we have heard that from council members, that inflation is set to go slightly below target, or maybe even significantly, depending on who you believe. But then the question really is what it will do after 26. Right. Will it go up again to 2, or will it stay below, which will be very important for the rate outlook?
But Jens, I mean, first of all, is the economy in such a bad shape that it needs to be stimulated with rates lower than 1.75%? Because that feels quite a big deal.
Yeah, no, I mean, and first of all, I think it's all through the lens of inflation that you look at that. And then the second part, you look at whether growth is at potential or below. So basically, is the output gap opening, or is it closing? Our own forecast is that the output gap is actually not closing, it's actually staying where it is or getting wider. And then with inflation below 2, you can, of course, cut below 2%, which, broadly speaking, is probably neutral.
So do you think there is a danger that actually inflation persistently undershoots 2%?
You cannot exclude that from now. I mean, what you could see if you look at inflation, I mean, there are two things. Volatile components, FX, oil, point to downside risk, but they are volatile. And so you wouldn't want to give too much weight to them here. But then there's wage developments, which are really setting core inflation. Here, the German labor market is very important. The German labor market is weak. Yeah. Normally, at this time of the year, we see an improvement. It's not improving. Actually, that bodes ill for further wage agreements. We have it down to 2.4 next year. Euro area wages, all of which is still a tad above pre-COVID wages, but not that far. So there is a risk we go back to pre-COVID inflation dynamics significantly below 2%.
I mean, it seems like actually the market is extremely undecided just because of these tariff concerns that we don't know where they land. So is there a case to actually just pause until we figure out what tariffs do, or is it impossible because then you'll be too late?
No, I think that's exactly the sort of decision problem that the ECB is facing. They can't go too quickly, which is why we think it shouldn't be July. It will very likely be September that there's the next decision. At the same time, indeed, you can't decide too late, because then when it's too late, it's too late.
What's the worst scenario, that you're too late in cutting or that you're too soon in cutting, given the dynamics? Again, tariffs, look, the prospect for trade wars change every day, right? Today, again, the markets are selling off because of U.S.-China.
Yeah. Meanwhile, uncertainty is weighing on. Even if, in the end, the outcome is a better tariff rate than we currently expect, I'd say risks are to the downside all over. So from that perspective, to your question, I think the risk is rather that you're too late than that you're basically not staying put enough.
Yeah, and again, the landscape, as you rightly said, has changed so much since March. How likely is it that it could change significantly again until September? Or do you think at least now we have the overarching idea of what the global economy will live through?
Yeah, no, I think, first of all, I think it's certain that we have less growth than we had expected still in November, which had already some tariffs in. Yeah. Then the question you have to ask is there a significant upside left? Yeah. And we think not really. Of course, we do have an upside scenario in our recently released outlook, and a downside scenario. But the upside scenario is much more modest than the downside scenario.
Jens, when you look at the defense budget in Germany, when does it impact growth and inflation?
Defense tends to have a low multiplier, and you only over time, by rebuilding the defense industry, which is underway as a process, you might get to higher multipliers. So all of that means most of that should come significantly after 27. Mm-hmm. The other question is on infrastructure. That could be quicker, but here again, it takes time. So if you take this 500 billion, very simplistically speaking, which is the size of the program in Germany on infrastructure, there's this 12-year planning horizon, but it's only planning. Then the spending is over maybe 20, 25 years. So that gets you to a much lower per annual or annum increment in terms of spending, and probably only hitting the road after 26.
Jens, I know, as a chief European economist, how much do you look at U.S. move in treasuries and dollar? Because it seems that some of them are, if not irrational, certainly very violent, certainly when it comes to treasuries. But then the market's like, oh no, everything's fine, and they go back to behaving in a more normal way. Do you worry about an auction or like a market event in the U.S. that really infects Europe?
For sure, we have at least the market looking at the potential regime shift here. We just have published a piece looking into what would be dynamics if just, say, global reserve currency, percentages, shares, the euro would go up to 28 where it was in 09. And of course, that would give you significant euro strength, and that has negative repercussions for growth. Significantly so.
I know. Morgan Stanley, the team saying that the dollar could fall some 9% on slowing U.S. bets. It had everyone in a tizzel in the newsroom. What are the implications for the rest of the world?
So, in general, a big shock to the system means adjustment all over, and I don't think that this will be throughout in just the lens of growth. If you look at it from the perspective of growth, it will be negative, just because of the adjustments to trade flows and so on and so forth.
What is there anything that the market is not seeing or not pricing in that you worry about in the economy?
Well, of course, so far we have this problem that hard data is not really telling us the full story. Right. It's not really falling off a cliff, and we are also trying to understand what is the extent of the adjustment of the economy, and of course that could be more to come than what we are currently seeing. So from that perspective, yes, there may be further downside risks that are not fully acknowledged yet.
Yeah, but is that because of the cost of money? Is it something structural, or is it just because it's taking time to filter through you think it's just taking time? Because
the shock is so big. So you have the front loading that's typically seen as one of the key explanations for the strong first quarter. It could go on in the second quarter, and then you might come into thinking, at least if you look at the equity markets, which are more or less back where they have been pre-April 2nd, then you might come thinking, oh, it's all not too bad. But, there will be a hit to global sharing of labor, and that will be a hit to growth, for sure.
Yeah. And Jens, I guess I don't know whether, your job has become more difficult in the last 10 years because there's so much more money also in private markets, and that's much more difficult to measure. And so does that skew data that you look at?
That's a good question. From the academic literature that I know, I'm not aware of a systematic bias there. But it's true that for sure this is a debate in the market, right? Whether we have essentially a glut in liquidity that's actually making it harder to extract signals from equity prices, for instance.
Okay, Jens, thank you so much for joining us today. That was Jens Eisenschmidt, the chief Europe economist at Morgan Stanley. Now, coming up, oil gains after a smaller than expected output hike from OPEC Plus. We'll break down the details and talk Brent and talk WTI. That's next, and this is Bloomberg. Emirates President Tim Clark says the airline is seeing full flight bookings through the year. Now, that's despite global uncertainties that he says the industry is preparing to confront. Well, Clark spoke to Bloomberg's Guy Johnson.
We're just entering to the summer peak season. Our flights are all booked full, in fact, booked through to the winter. As far as the uncertainties, we're kind of used to all of this. I think the markets are so much more resilient now. They went through a difficult time during COVID, and that has strengthened their resolve to keep moving. I'm not alone in that. Every time I talk to other members of the community that we are competing with each other, they say the same thing. It's so far so good. There have been some problem areas. We know about North America, Canada, to an extent the North Atlantic. But so long as there is a state of change, as we know that's going on at the moment, with regard to tariffs coming off, tariffs coming off, levels falling, levels increasing, I think people are just keeping their powder dry, waiting to see what's going to happen.
But that's not causing people to stop spending. They're still spending in the way that they were.
They are. They continue to do that at fair levels, which are very healthy as far as we're concerned.
Are you getting an inkling that you're about to see the manufacturers, the OEMs, the Boeings and the Airbuses and the engine manufacturers raising prices? Because they are being affected by tariffs at the moment. They are seeing that impact. Is that something that they're ultimately going to try and pass on to you?
Well, in the end, we'll have to have that conversation. I don't believe...
Do you expect to have that conversation?
I think it may happen, but they're not in a position at the moment to say exactly what is going to happen to their cost structures because they don't know what the supply chain effect is going to be. If you have 140% tariffs in one day and then it's down to 10% the next day, they've got to just take stock and take a medium to long-term view as to what their costs are going to do, and then have a conversation with us as to what that may be. As far as we're concerned at the moment, they can absorb that. They need to absorb that. Until it gets to a point where it's not absorbable, if I can use that word, and then we have that conversation. But it's too early to engage and say your price is going up 10%, your price is going up 5%, etc. Because as soon as things change positively, then we would expect those prices to come off. So you get a situation where the negotiation with these vendors, the OEMs or whatever, becomes difficult, complex, and a little bit timely, and in the end, it's time wasting.
Well, that was the Emirates President Tim Clark speaking to our very own Guy Johnson. Now, meanwhile, U.S. airline Delta says it's expecting travel demand to recover in the second half of the year. That's after price-sensitive passengers in the U.S. showed spending restraint in recent months amid a worsening economic climate. Well, the chief executive Ed Bastian also spoke to us exclusively at IATA's AGM.
I think in the U.S. structure, lower ticket prices is part of the reason we're seeing lower prices as costs have come down. It's helping to insulate the fall off that we've seen from expectations on demand. Year over year, though, demand hasn't fallen. Demand's pretty flat and I expect in the second half of the year, it hopefully will tick up a bit.
Well, oil prices higher this morning after geopolitical and trade risks ramped up over the weekend, and OPEC Plus hiked production by less than some feared. Now, for more, let's bring in Will Kennedy, our senior executive editor for energy and commodities. So, well, there's a bit of a mismatch between what the market was expecting and what they actually ended up getting.
Well, they got more oil, 411,000 barrels a day, which was the scenario that people had been talking about mainly in the run-up to the meeting. On Friday, there was clearly a discussion or a suggestion that Saudi might try and go even faster than that. No. Didn't happen. So I think the price action today partly reflects the fact that there was this possibility that there would be an even bigger supply increase, and that didn't happen. So there's a little bit of relief there.
So when you look at prices, how are they faring in the face of this continued tariff uncertainty?
Yeah, prices are holding up relatively well. We're getting all this oil back into the market, and yes, we're down in the low 60s, but they're held up there. And I think underlying this, especially among some OPEC members, is a feeling that the fundamentals of the market aren't too bad. Lower prices have helped presumably shore up demand. We've seen a strong start to the driving season in the United States. We've heard some optimism there about how much people are traveling. So yes, prices are lower, but the fundamentals of the market are probably quite strong, and there are other places where supply may not be as rapidly expanding, notably the shale patch in the US. So we're lower, but I think the Saudis will think that the fundamentals aren't all that bad.
Yeah, the Saudis really are kingpin, right, of OPEC. They're kind of deciding everything. What do we know they want?
I think they want several things. I think they have probably three broad strategic reasons for pursuing the policy that they're pursuing, which is, of course, different to the policy that they had been pursuing, which was to rein in production and keep prices high. I think those reasons are to enforce discipline within OPEC Plus, some frustration with overproduction from countries like Kazakhstan and Iraq. I think it is to grab back market share from shale, among other places. And I think the geopolitical context is important, and clearly Donald Trump, a key Saudi ally, wants lower oil prices. And you put those three things together and you sort of got a mixture of strategic reasons which mean that Saudi Arabia decided that it was going to pursue a different strategy.
Yeah, what happens next? Do they redecide depending on where the the price of oil ends up in September, or could it be sooner?
Well, we know that the Saudi oil minister, Prince Abdulaziz, he likes to be agile, he likes to keep people guessing, he likes to manage in the short term. I think that the expectation is that we will get at least one more of these 400,000 barrel day increases. Beyond that, it's hard to see. Some people say it's slightly weaker fundamentals going in towards the end of the year, so I think they'll be very, very alive to what the demand and supply fundamentals look like month by month.
Well, thank you so much, Will Kennedy, there, Senior Executive Editor for Energy and Commodities. Now, BYD shares have continued to plunge despite monthly sales climbing to the highest level this year. Now, this comes as the electric vehicle manufacturers' steep discounts draw scrutiny from Beijing. Bloomberg's Katrina Nicholas is here with the latest. Katrina, so why doesn't the Chinese... Good morning, first of all. But why doesn't the Chinese government like BYD's sales strategy?
Well, I think it's important to note that Beijing hasn't explicitly come out and named any car makers here, although a lot of commentators have sort of assumed that BYD is the company they're talking about. And they came out over the weekend in the People's Daily, which is essentially the mouthpiece of the Chinese Communist Party, criticising this sort of rat race that is now taking shape in China's EV market. Price war has been a feature of this market since about early 2023. We've seen car maker after car maker sort of slash their prices continuously, and it's sort of resulted in this downward spiral, and it's really eating into automakers' margins. Good news for consumers, although with the lackluster economic environment in China at the moment, it doesn't seem to be driving perhaps as many people into showrooms as the automakers would like. And one of the concerns that the government has is that it's saying, these sort of lower priced and lower quality products could seriously damage the international reputation of made in China vehicles. Just as a time, I think it would be fair to say that made in China vehicles are actually starting to come onto their own into the world stage. Certainly in BYD's case, we're seeing them exporting to a number of markets around the world, particularly into Europe, into Southeast Asia, and their cars are being, reviewed as being very good quality, packed with very high-tech technology, and certainly also value for money.
And so is what we're seeing now just a BYD issue, or is it more systemic across China?
So BYD has not been the only car maker cutting prices. BYD late last month sort of kicked off another round. They cut prices by as much as 34% across various models. And that, of course, saw other automakers follow suit. Geely, Leapmotor, they all announced price cuts of their own. I think for BYD's case, it's interesting to see what effect that's having on its sales. We had sales numbers for May for BYD out yesterday, and even though May was actually the best month for BYD so far this year in terms of sales volumes, month on month, it was only, year on year rather, it was only up 15%. Now that's the slowest growth for BYD since about August 2020, barring one particular month in February over the Lunar Year. So you are seeing BYD's growth slowing. Now, BYD has set a target of about 5.5 million vehicles in 2025. Currently, 1st of June, 2nd of June, we're at a run rate of 1.76 million. Now, if you extrapolate that out, that you only gets to about 4.2 million. So it's looking quite short for BYD. And I think there are some concerns about, whether this car-making juggernaut can actually meet its full-year targets. Important to note, though, fourth quarter sales for all automakers in China are usually pretty strong, as car makers tend to sort of, get people in the showrooms towards the end of the year.
So interesting, Katrina. Thanks so much, Katrina Nicholas, there with the very latest on BYD and Greater China. Up next, it's Bloomberg Brief, and this is Bloomberg.